In this video, we're going to talk about the parabolic price pattern. And this is actually a pretty powerful tool for traders when you know how to use it. Now, the parabolic price pattern, it's a pretty distinctive curve, and it emerges during bullish trends. And this can indicate a potential shift from a bullish market to a bearish market, because this unique curve, as it shows an instrument, is quickly becoming overextended and a prime candidate for mean reversion type setups. Now, to master this pattern, you really got to grab some pretty key concepts. So let's look at those. So you've got to be adept at identifying a reversal signal. You got to be able to calculate some profit targets. You got to be able to apply some risk management techniques. Now, this pattern can actually be used as a standalone pattern, but it actually becomes a little bit more potent when you combine it with other tools, like even Fibonacci retracements. So recognizing this pattern is the first step. So essentially, start by tracking a bullish trend. And you want to look for a series of measured pullbacks, and it looks like a stair-stepping structure. Then you want to draw a curved trend line beneath those pullback lows to form that arc. So now this pattern, though it appears in bullish trends, it actually signals a potential shift towards bearish market behavior. And that shift is driven by market psychology, because greed then gives way to an unsustainable trend. So let's talk about how we can implement a strategy. So your entry point would involve selling when the price breaks beneath the trend line. However, every trade's going to carry a risk, okay? So it's really crucial that you set a stop loss order just above the pattern's upper extreme. Mean reversion fails, it's going to rocket to the upside. And we're talking about profit targets. You can position them beneath your entry point. You can consider factors like risk-reward ratios and even Fibonacci retracements. And we can always enhance our strategy with a different indicator, add to it. So we can use RSI, or a moving average convergence divergence, the MACD. And this is going to give you some deeper insights and validation for your decisions in trading. And you don't want to forget the importance of risk management in your strategy. So let's pretend that the RSI is overbought, or the MACD is starting to curve downward. Then you actually may have a trade in the near future, as that uptrend is unsustainable. So to wrap this up, this pattern is pretty valuable, but it's not foolproof. You really want to have risk management and combine with other indicators. That's going to help it be a bit more successful. But remember what we're doing. We are trading against the overall trend when we use this pattern. So you want to make sure that your risk management, your stop loss, your profit targets, these are all set. Now, recognizing this pattern, that's just the beginning. You got to learn to use it effectively in your strategy. That's where you're going to find the success. And I hope you go over your chart, find out where you can see these unsustainable trends, backtest, look what's happened in the past, how the reversal's set up. And that's how you're going to build your trading strategy.